Welcome to financial uh, and management accounting. So we'll look at assorted papers, a combination of theory and calculation. So first 10 minutes, we'll just quickly rush through um, some theoretical questions. So from May 2018, question number one. Question number one reads, financial accounting has been described as the classification, recording of monetary transactions of an entity in accordance with established concepts, assumptions, principles, accounting standards, and legal requirements, and their presentations to users by means of income statements, balance sheets, cash flow statements, during and at the end of the accounting period. So, question required to explain the following was giving two examples. What are assumptions, principles, accounting standards, and compare a sole trader and limited company. So what are assumptions? So assumptions are simply what? The basic conditions or ideas on which the accounting process is based. Accounting assumptions, these are basic what? These are basic assumptions that underlie the preparation of financial accounting. So we have examples of assumptions. We have what we call the going concern. We have what we call the accruals assumption. So these are the examples of assumptions that we have. We have the economic entity, going concern, um, monetary unit, and periodicity. So what do each of these ones imply? So they are mixed, do not mix principles and accounting assumptions. So assumptions are simply basic what? Underlying ideas or foundations on which financial statements are prepared. So they'll give or provide a framework for recording, for presenting financial information consistently and meaningfully. So we have the following assumptions. We have what we call the economic entity assumption. This assumption simply states that the business must be treated as a separate and distinct entity from its owners. So meaning the personal transactions of the owner must not be mixed with those of the business. We also have the going concern assumption. So this assumption assumes that the business will operate for a foreseeable future and will not liquidate or significantly reduce its operations. We also have the monetary unit assumption, which simply assumes that all business transactions should be reported in what? In a common monetary unit like the Zambian kwacha. So it assumes that the purchasing power of money remains what? Stable over time. Can give an example. An example would be that sales and expenses are measured in kwacha. You ignore inflationary effects. Periodicity assumption. It assumes that the life of a business is divided into specific accounting periods like months, years, for the purpose of reporting. An example you can give is a company should prepare annual statements ending 31st December each year. So these are what? These are assumptions. So these accounting assumptions really will provide you basis upon which the accounting process is built. So quickly, these are they. All right. So compare a sole trader and other limited companies. So a sole trader, I shouldn't waste much of the time on these ones, but we're looking at here a sole trader and other limited companies. You must know at least the basics of these ones here. Who is a sole trader and what is a company and what are the differences? When doing the sole trader, basically we're looking at what? The one-man business. So this main difference is that number one, the term sole simply suggests that the business is owned and controlled by one person. This person makes all the decisions. It's very simple and inexpensive to start up. Then A sole proprietor is easy and cheap form of business to set up. So it carries a high personal risk, and the owner is personally responsible for all the debts. So if the business fails, the creditors can claim personal liability. That's why it has unlimited liability. All right. Then the profits are all tax as personal income, and the profits belong to the owner. The company is limited, is formed by two or more people who are known as shareholders. So its main characteristics are there's a separate legal entity, and you have to register the company. The entrepreneur is separate from the owner. Okay, this one has what we call um, limited liability. Okay, so liabilities are limited, meaning shareholders aren't personally liable. It is easier to finance and to sell shares, and profits are shared among the shareholders through dividends. So the business tax, is, so these are the characteristics of a limited company. Am I clear? Now let's go to some calculations now. Okay, is my network clear?
Yes, it is. I was just wondering whether you will share this after.
Yes, I'll share it. I think I've already shared those are in the paid up group. I've shared the pamphlet. All right, now let's quickly go to some calculations. So I'll be mixing calculations and theoretical questions so that we have a balance. Every day, at least we have 30 minutes of such discussions before we proceed into the most complex things. So the first question um, in your paper is often capital budgeting. Capital budgeting. So we have been given a question, as you can see there. I told when as an entrepreneur who's keen to um, venture into projects involved in setting up a new fish hatchery in Chiwambo district. So he saw an advert from CEC inviting applicants to apply for funding. So she completed application form, but ensured that the section of profitability proposed project, whether the project is financially viable. She has estimated that she would need 200,000 to set up, and the forecast is as shown below. So this is what you are seeing below as her forecast. So now the question is, number one, let us describe any four methods that Kunda could use to determine whether the proposed project is financially viable. And using the four methods we described, calculate the financial viability and advise Kunda whether the project is financially viable and what indicators are used. So I need us to participate. So the first part of it, let's explain any four methods that she can use to determine whether it's financially viable. These ones should be at your fingertips. What are they? Number one, come on. This is the free mark part. Anyone? What are the four methods that would determine financial viability? We have the payback period. This method will help calculate the number of years for the project to recover the initial cost. So it's simple to measure liquidity and risk, and a shorter payback period means the project is preferred. We have net present value. This one calculates the net present value of the future cash inflows. So it uses the cost of capital, in this case, 15% to discount the future cash flow. So if you have a positive NPV, it means the project is viable. All right. If you have a negative NPV, it is not viable. Then we also have profitability index, which is also known as the benefit cost ratio. So this method is calculated by dividing the present value of the cash flows divided by the initial investment. So it will show the value per unit of the investment. So if we have anything more than one, it will indicate that the business is viable. Then we also have IRR, which is the internal rate of return. So this is a discount rate that makes NPV of the project equal to 0. So it will represent the project's expected annualized rate of return. So the project is considered to be viable if the IRR will be more than the cost of capital. So these are the four. Okay. So of these four methods, we've now been asked to do what? To calculate the financial viability of each of them. All right, so we are given the cash flows in here. And we are expected to now calculate each of these ones. So who remembers any calculation we can do from there?
I think I remember the payback period.
Okay, the payback period, good. So how do you do the
So for the
payback period?
payback period follows the time. So you consider how much you've been given. You've been given 300,000. So year 0, put 300,000. Then 1 this side. Then we subtract from 300,000. Like we want to get the 300,000. So from the 300,000, we have the 20,000 in year 1. So we'll do 300,000 minus 20,000, which will give us 280. Am I right?
Yes, 280.
Yes. Then year 2, we have a 50,000. We write a 50,000 the way you've shown. Again, we subtract from the 280 that we've remained with. We'll have a 230. Then year 3, we have 150,000. We subtract from 230. We'll have 80,000. Then we have year 4. So now in year 4, we have 160,000. Then from the 300,000, we just want 80,000 to make up to 300. So we'll just get part of it. We'll do 80 divide by 150. 80,000 divide by 160,000. I don't know what is it giving? Is it 0.5? I don't know if I'm right. Then I'll count the years that we've used, 1, 2, 3. So it will be like the time to recover this 300,000, it will take us 3 years, 0.5. 3 and is it 3 and a quarter? Okay, something like that. Maybe I can
half. Oh, good. 0.5. So we give you 3.5 years, right? Very well explained from your peers. Is anyone behind on how she's calculated that? Are we all understood? So you only need 80,000 to still recover the cost. And the cash flow in year 4 is 160. All right, so you divide the 80 over 160, then there you go. That's 3.5 years exactly. So this is how we calculate the payback period. That is correct. We have 3.5, so that is correct. Is anyone behind still on how she did the calculation? Do I need to go through it again, or we're clear? Payback. Do I need to go through?
Sorry, can you go through it again? I remain behind.
All right, okay. Or I can use another method, if you like. So for the initial cash outflow, you can leave it as it is if you want. Put a dash there. You start adding the 20,000 here. You add the 50,000. You get what? 70,000. Okay. Then 70, you add the 150, what do we get? 70 by 150, what do we get? 220, right? 220, you add what? 160, what do we get? I need your participation in your calculation. Calculator is nearby. So 160. So 8 here and 3, 8. And 170, we get this is 15 and 4, 550. So what did we do in the method 2? We ignored the initial cash outflow of 300. We just started here. 20, you add to the 50. 70, we add to the 150. 220, we add to 160, 380, and 550. So you look, these are cumulative figures here. You look at the period within which initial 300,000 will be paid. So the 300,000 will be between what? 220 and 380. So use what we call a diamond formula. This is your A, your B, your C, and your D. So our payback period is simply A plus B minus C over D. So our A is the 3 years. So you look at the period within which the 300 will be paid will be between 220 and 320. So in this very line, that is where your A is. Your A is what? 3. Plus B is the actual cash flow you want to pay back, the 300,000. Minus the same line here. Our C is the same line as the A is what? 220 over our D plus actual cash flow here 160. So we're going to have 3 plus 80 over 160, which is the same answer we got as what? 3.5 years. So I repeat, if our initial cash outflow, for instance, was 400,000, what would be our A? You identify where the 400,000 will be captured between 380 and 550. So your A could have been the 4. Your B is the actual cash flow. Your C could be the actual 380. Then your D should be 170. Just follow this diamond. A, B, C, and D. Is this easy to understand?
Yes, thank you very much. Followed it well.
All right. So this is how our computation for the payback period could be done. So we also have another method to calculate your NPV. For the NPV, you have what? The cash flows. Who remembers how to do the cash flows? So you can use the tables or you can use the formula. So NPV, you just want to discount the cash flows. The formula for NPV is what? NPV could be given by cash flows over the discount rate 1 plus R to the power N minus the initial cost. It's a shortcut or simplest way. So you start with 20,000 divided by 1.15 to the power 1. So it's 15%. Plus the following one is what? 50,000 over 1.15 to the power 2. The next one is what? 150,000 divided by 1.15 to the power 3. Are you following? Then 160,000 over 1.15 to the power what? 4. And finally, 170,000 over 1.15 to the power what? 5. Then minus the initial cost, which is our 300,000. So this is the easiest way. When you calculate that, you're going to find your NPV as what? 300. So when you add this and that and that and that, the total here will be what? 329,000. So we're going to have 329,000. So when you add the answer here and compute it, this is 17,000. 391. When you calculate this one from the 50, you're discounting it to that 7,000. When you discount the 150, you're going to get 98,000. When you discount the 160,000, you're going to get 91,000. When you discount the 170,000, you're going to get 84,000. Okay? So this is a two-way thing. If you're using it manually, it looks like this. If you're using it using the discount factor, you just go on the table under 15%. Year 1 is 0, year 2, 15% is 0.86, year 3 is 0.75, up to year 5. Then you simply multiply the cash flow times the discount rate. So 20 by that, we get this. 50 by this, we get this. 150 by that, you get this one. Until you go to 170 by the discount rate. So this total here is what will give you 329. Okay? 827.16. So now you subtract the what? Initial cost there of 300,000. So remember the rule from the notes is that you only get a project that is what? Viable by understanding the positive part only. So if you get a positive part, this is called a what? A viable project. So when you subtract 329 minus 300, what you remain with is what? 29,000. So this means that our project is viable. How together? Then profitability index is simply dividing our total cash flows. Profitability index is simply dividing our total sum of cash flows, summation of the cash flows over summation of it's simply summation of the present value over initial cost. Okay. So total PV over cost. So if you get an answer which is greater than 1, then the project is viable. So in this case, we had what? 329 divided by 300. So our cash outflow is more than our initial cost. So we're able to tell that this is what? A viable project. So profitability index can be calculated. So we're going to get 1.099. So this will tell us and indicate that this is what? A viable project. So here we find 1.099. So we can say it's a viable project. Are we together? Are you following?
Yes.
So IRR, you just need to use interpolation. You can guess on any two percentages and use the following running percentage, and you use a formula. Remember the formula for IRR? What's the formula for IRR? R1 times NPV1 over NPV
1 minus NPV 2.
1 minus NPV what? 2. Then times what? R2 minus what? R1. So you can use, at least we know that our R1 at 15% was what? Give us an NPV of, what was the NPV? We had an NPV of 29,827, a positive figure. Then you can use another percentage slightly higher. If we try 18%, it's giving us a positive figure. So we are better off finding a percentage that will give us a negative figure. If we try at 19%, we're getting a negative figure. So we get 19% as our R2. Preferably, you can get 10 years difference because this is interpolation. You can even put 20% or 25%. So here, 19% is giving us our NPV what? 2 of how much? If you compute it, will give you NPV2 of what? Negative 7,852. All right, then you now put it in here. Our other one will be what? 15%. Plus NPV was what? 29,827 over 29,827 minus negative 78,52. R1, R2, so 19% minus what? 15%. So when you compute that very well, you compute and find your IRR. Okay? In this case, the IRR is 18 point what? 18.11. So this IRR is now what you compare with our 15%. If it's more than 15%, you say it's viable. So when you compute this, you're getting your IRR as what? 18.11. So versus the discount rate of what? 15%. So you can only declare that your project is viable if the IRR is more than that. So let's look at the indicators before we advise Kunda. Payback period, we found 3.5 years. NPV is a positive, which is 29,000. Profitability index is more than 1, which is 1.00. And internal rate of return is above the 15%, which is 18 point something. So what would be your advice? What would be your advice? So you break down the advice based on what? These parameters. So you could simply say, all right, Kunda, let's see your decision. Your NPV is positive, which is 29,000. So this is the most critical factor when considering your cost of capital. So the project will increase nearly by what? 30,000 positive acceptance. Then here, PI is 1.08, which is greater than 1. So it means that for every 1 quarter you invest, your return will be 1.099 in terms of present value. So you create value of 0.99 for every 1 quarter. So this confirms that the project is viable. Then you go to internal rate of return, which is 18.11%, which is higher than the 15%. So this indicates that the project is expected to exceed the minimum acquired return, so it makes it more attractive. Then finally, payback period is 3.5 years. Well, this one ignores time value. You are looking at a period track of a 5-year project, which is acceptable. The earlier, the better. So it shows that there is lower liquidity risk. So you have now analyzed everything in full context. Is that clear? Are we together?
Yes.
All right. So we end here.